Welcome back to Capital Crew, your go-to source for financial insight. Today, we're diving into a topic that's on everyone's mind. What do UK interest rate rises mean to you? With interest rates on a 15-year high and inflation still lurking in the shadows, it's crucial to understand how these changes affect your money. So grab your notepad and get ready for an eye-opening discussion. Now that we've set the stage with the latest interest rate hike by the Bank of England and its implications, it's time to delve deeper into what these rate rises mean for you, your mortgage, your savings, and the broader UK economy. First and foremost, why is the Bank of England so keen on raising interest rates? Well, it's all about tackling inflation. Despite a slight dip, the cost of living remains stubbornly high at 6.8%, which is far above the central bank's target of 2%. The theory is simple. By making borrowing more expensive, the bank discourages spending and encourages saving. This decreased demand for goods and services should in turn lead to lower prices, eventually helping to curb inflation. But with the bank having already hiked rates 14 times since December of 2021 from a record low of 0.1% to the current 5.25%, the burning question is, how much further will they go? Now let's talk about mortgage. For a third of UK households with mortgages, this rate hike hits home, quite literally in fact. If you're on a tracker or variable mortgage, your payments will almost immediately increase in response to the base rate hike. These mortgage types move in lockstep with the Bank of England's rate. When it rises, your payment rises. When it falls, your bills fall too. With 639,000 properties on tracker mortgages and 773,000 on standard variable rates, it's safe to say that 1 in 4 mortgage customers has been witnessing their mortgage payments rise every 6 weeks since December of 2021. After a base rate change, your lender will send you a notification explaining how it will impact your mortgage. Check your mortgage contract for details on how quickly these changes should take effect. Let's break it down. The recent increase from 5 to 5.25% means that those on a standard variable rate mortgage borrowing £200,000 over 25 years are looking at roughly £33 more per month. The average variable rate currently stands at 8.09% according to Moneyfacts. Tracker mortgage holders with an average rate of 6.52% at the time of the latest rise can expect to pay around £31 more monthly. However, if you're on a fixed mortgage, you might feel some relief for now, but there's a catch. When your fixed deal ends, which could be sooner than you think, you'll likely be facing substantially higher payments. About 6 million households in the UK are on fixed-rate mortgages, and around 800,000 of these deals are set to end this year as the 2-year anniversary of the stamp duty holiday approaches. The rates for 2- and 5-year fixed deals, 75% LTV, are currently averaging 6.67% and 6.16% respectively, compared to the 1 to 2% rates just over a year ago. So should you consider remortgaging now? If your mortgage is approaching expiry and you want to secure a new deal, some lenders like NatWest, Nationwide, and Barclays allow you to do so up to 6 months in advance, starting from the date of offer issue. Consider a product transfer with your existing lender, which can save time and may not come with additional fees. However, don't assume that it's the best deal without shopping around. Interest rates can vary, so explore your options and consult a mortgage broker who can provide insights into deals that might be pulled soon. Now let's shift our focus to your savings. In theory, a rate rise should lead to higher interest rates on savings accounts, but many banks may have been slow to pass on these increases to savers. Even though savings rates have risen substantially since December of 2021, the average rate still lags behind inflation at 6.8%, meaning your money is losing value in real terms. One smart move could be to use your savings to pay off debts, especially since borrowing rates are higher than saving rates. Alternatively, consider making a mortgage overpayment, reducing your long-term interest payment. Also remember that you have a personal savings allowance on non-ISA accounts, so it might be worth exploring cash ISAs and considering investing for potentially higher returns over the long term. Shifting our focus to the broader UK housing market, several factors influence house prices, including employment rates, income levels, borrowing costs, property supply, and lending trends. When the economy is robust, with low unemployment, stable job security, and rising wages, more people can afford to buy houses. Low interest rates also make borrowing more affordable. However, the mortgage rates on the rise since December 2021 compared to the record lows of that time and the ongoing cost of living crisis impacting affordability, the housing market faces challenges. Lower interest rates typically stimulate demand as borrowing becomes cheaper, while higher rates do the opposite. Some economists are predicting a slowdown of up to 15% in the housing market this year, with Lloyds Bank even forecasting price drops and stagnant prices for the next 4 years. For tenants, the cost of living crisis is contributing to rent increases, particularly in major cities. Property portal Rightmove reports that city rental prices listed by landlords increased by 12% last year, with tenant demand up by 43%. This suggests that asking rents across Britain are likely to rise by another 5% throughout 2023, owing to the ongoing demand-supply imbalance in the rental market. And now that you understand the multifaceted impact of interest rates, let's demystify how the Bank of England sets these crucial rates. In conclusion, the recent stirring of interest rate hikes by the Bank of England has sent shockwaves throughout the financial landscape. It's crucial to keep an eye on how these changes affect your personal finances, particularly if you have a mortgage, savings, loans, or credit card debt. For mortgage holders, be prepared for potential increases in your monthly payments if you're on a variable rate. Fixed-rate mortgage holders, while shielded for now, may face higher costs when their deals expire. The timing for remortgaging or exploring different mortgage options is crucial. With regard to savings, remember that interest rates haven't fully caught up with inflation. Consider using your savings wisely, whether it's paying off debts, making mortgage overpayments, or exploring investment opportunities. If you're in the market for loans or credit cards, be aware that interest rates are on the rise. Review your options carefully and be prepared for higher borrowing costs. For pensioners, an annuity purchase could benefit from a base rate increase, potentially yielding better returns. And lastly, the housing market's fate hangs in the balance. Keep an eye on how rate hikes impact housing prices, whether you're a homeowner or a tenant. In these uncertain financial times, staying informed and making strategic financial decisions is more critical than ever before. As we approach the next Bank of England interest rate decision on September 21st of 2023, do be sure to follow the updates and assess how they might affect your financial situation. Remember, financial stability and planning are the keys to navigating the shifting tides of the economy. Whether you're saving, investing, or managing debt, knowledge is your most potent tool in securing your financial future. Thanks a lot for tuning in to Capital Crew. Do stay informed, stay financially savvy, and stay ahead of the curve. We'll be back with some more insights and updates on the ever-evolving financial landscape. Until then, take care and make those financial decisions wisely.